Compxm Final Exam Answers, Compxm 2025, Compxm 2026, Compxm Round 1 to 4 Answers, Compxm Round 1, a practical MBA level guide to scoring 99% executive summary. This guide provides a comprehensive walkthrough for achieving optimal results in Round 1 of the Compxm business simulation. By integrating strategic analysis, market insights, and evidence-based decision-making across all departments, R&D, marketing, production, TQM, human resources, and finance, this guide aims to help MBA candidates secure high performance, including a target of 99% in the decisions section of the balanced scorecard. Research and Development, R&D, Strategy 1.1. Understanding segment-specific needs. Each product in Compxm is associated with a distinct market segment: core, nano, elite, and thrift. To succeed, the R&D decisions must align product specifications with evolving customer expectations as defined in the Industry Conditions Report. Core segment, product, AR, key criteria: O price sensitivity, 46%, O age 2.0 years, 20%, O reliability, 16K, 22K MTBF, O ideal positioning, 16%. The product AR underperformed due to overpricing, while its reliability, 22K, and coordinates were acceptable. Perf, 8.4, size, 11.6, the price exceeded the customer threshold. To improve, performance was adjusted to 9.4, size to 10.0, and reliability maintained. This revision results in an age of 1.7 by year-end, aligning closely with the customer preference of 2.0. Nano segment, product, A&T, key criteria: O ideal position, 35%, O price, 28 to 40, 27%, O age 1.0, 20%, O reliability, 18K, 24K, 18%. A&T's performance and size were adjusted to improve its market fit. New specs: Perf, 6.5, size, 6.0, reliability, 22,000 MTBF. This results in an end-year age of 2.0, starting from a revision age of 1.0. Competitor analysis indicated lower price and better accessibility, prompting future marketing adjustment. Elite segment, product, S, key criteria: O age 0.0, 38%, O ideal position, 22%, O reliability, 20K, 26K, 20%. Despite a general inability to hit exactly 0.0 age, our elite product was revised to Perf, 14.4, size, 8.2, reliability, 24,000. This yielded a revised age of 1.0, improving with TQM support later. Thrift segment, product, EU, key criteria: O price sensitivity dominates, O performance less critical, O reliability. Secondary price misalignment was the major issue. The R&D change involved adjusting coordinates slightly. Perf, 7.0, size, 13.5, reliability, 17,000. Introducing new products. 3 new products were introduced to target market gaps and drive future growth: Product X, crossover product, O segments, core and nano. O perf, 12.0, size, 8.0, reliability, 22,000. Product Y, nano focused, O perf, 13.1, size, 4.8, reliability, 24,000. Product Z, elite focused, O perf, 15.6, size, 7.2, reliability, 26,000. These products were scheduled for revision with the aid of TQM to ensure optimal age and customer fit. Total Quality Management, TQM, enhancements to improve revision timing and efficiency across R&D and production. Each TQM initiative was funded at $1.5 million, the threshold for diminishing returns. Key outcomes from TQM investment included: reduction of product age at revision, critical for nano and elite segments; improved accuracy in production scheduling; enhanced alignment with customer expectations. Marketing Strategy 4.1 Pricing adjustments for underperforming products like EU, thrift segment. Pricing was revised significantly downward, from $32 to $20, to match price-sensitive customer expectations and regain market share. 4.2 Promotion and sales budgeting. Customer awareness and accessibility decay annually. To mitigate this, promotion budget, set to $2 million. Sales budget, set to $2M, 2.2M. Diminishing returns were accounted for. First $1 million equals 22% gain, second $1 million equals 23% gain, third $1 million equals only 5% gain for segments with multiple products, e.g., Nano and Core. Combined spending was capped at $4.5 million to maximize returns without waste. 4.3 Sales forecasting. Sales volume was forecast using historical sales data, growth rate, and anticipated accessibility and awareness improvements. Product forecasted sales are 2,000 units and 890 units, S950 units, EU 1,950 units. Production planning. 5.1 Scheduling. Production was scheduled slightly above forecasted demand to account for unexpected surges without overstocking. Product forecast schedule AR 2,000 2,150 and 890 900 S950 970 EU 1,950 1,320. Excess inventory already available. 5.2 Capacity and automation. Capacity was adjusted based on the introduction of new products. Capacity added for each new product, 400 units. Automation levels, OAR, Core 7.0 EU, Thrift 9.0 others, 5.0 to 5.5 Rationale. For price-sensitive segments, Core, Thrift, higher automation helps reduce labor costs and lower prices sustainably. Human resources. The HR module was optimized using the maximum permissible values without triggering diminishing returns. Recruiting spend, $5,000 per worker. Training hours, 80 hours per year. Benefits included, lower turnover, higher productivity index, PDI, better labor efficiency supporting automation. Financial strategy. Finance decisions were deferred until all other departmental budgets and forecasts were completed. This ensured accurate cash flow planning and avoidance of emergency loans. 7.1 Key considerations from the balanced scorecard. Low points in leverage and working capital days triggered corrective actions. Shareholder value and cash position were closely monitored. 7.2 Financial moves made. Long-term debt issued, $14.7 million. Short-term debt issued, $6 million. Equity issued, initially $8 million reduced to $5 million, to improve leverage ratio. 7.3 Outcome monitoring. Final adjustments were made to ensure positive December cash balance. Leverage within benchmark, target 2.0. Avoidance of emergency loans. Summary of key metrics achieved. Department action taken. Result: R&D product realignment. New launches. Optimal age and position. Marketing, pricing and budget optimization. Improved market share and awareness. Production schedule matched demand plus buffer. Inventory managed efficiently. TQM $1.5 million per initiative. Reduced revision age. HR max. Recruitment and training. Higher productivity and retention. Finance balanced funding mix. Improved cash and leverage. Final recommendation: synchronize R&D and TQM. Always use TQM to shorten revision age, critical for nano and elite segments. Avoid equity issuance unless necessary, it dilutes share price, impacting shareholder metrics. Price sensitivity is paramount, especially for thrift and core. Automation should serve price strategy. Cap spending smartly, respect diminishing returns in promotion, sales, and TQM budgets. Monitor balanced scorecard constantly, each decision impacts multiple areas. Holistic awareness is key. Conclusion: Round 1 of Compxm lays the foundation for long-term success in the simulation. With an MBA-level understanding of customer preferences, financial strategy, operational planning, and performance metrics, a team can optimize both immediate and future results. By following this structured approach, participants can expect to score close to or even achieve the ideal 99% score in the decision section, setting a solid tone for the remaining rounds. Fastest support TO get top results $9.99, email, behelp2002@gmail.com, blog, https://capxmguide2021.blogspot.com, free Excel file for all 4 rounds, download from blog or send the email, Online quick support Q&A equals WhatsApp equals https://bit.ly/3silp9u. Whole game support equals $40 for 4 rounds plus 5 quizzes. Support equals top results.